Hey New Zealand, today we're going to look into a very important topic, which is essentially understanding when does it make sense to refinance your mortgage. Now, you've been at the local barbecue or you've been at the pub or wherever you've been looking at mortgage rates in an environment where they're decreasing. So obviously, when you're going off the 6% onto the 4.99, you want to make sure you understand what refinancing is and essentially what refixing is, which is a common confusion that people have. Refixing is essentially picking the rate from your current bank, and refinancing is moving banks. And we're going to separate the two out, and we're going to look into how to get the best deal from your current bank and how that is actually devised and what it entails. Second, we're going to look at when it makes sense to switch banks and what are the costs associated with switching banks. And the most important bit that you want to stick around for is the cost and mistakes of refinancing that people generally make, that we as mortgage advisors see day in, day out. So I hope you guys enjoy it. Let's get stuck into it. The first and most important thing when it comes to your mortgage renewal is looking at what your current bank can offer you. Whether you're at ANZ, Westpac, BNZ, Kiwibank, TSB, your bank wants to retain you. Now, the way they retain you or offer you a rate are two very different things. When they offer you a rate, they often base it on your LVR. Essentially, the LVR is your loan balance divided by the value of your property. And no, it's not what the real estate agent appraises your house for. It's not homestock.co.nz. It's not One Roof. It is the panel that the banks are using, which is either CoreLogic or Velocity. And it is the value on that day, not a historical value of what you bought the house for in 2021 or 2022 when the market was peaking. It's essentially what it's worth now. So they'll take the loan balance divided by the value. As long as you're below 80% on it, then you're going to get the best rate. And if you're not going to be able to see that through the bank or the person that you're dealing with, you should get a mortgage advisor involved. We'd happily make sure that if your LVR is below 80%, you're getting the most competitive rate. The second thing you want to understand is if your LVR is above 80% and you did buy at the peak and the value of your house has dropped by 100 or 200K, do not freak out. The rates have gone down. So basically you're going to get whatever rate is on the market, most likely a carded rate, or they're going to get the special rate, for example, 4.89. Let's say your loan divided by the value of your property on the panel is 90%. They'll go 4.99 plus 0.75 and give you 5.74% as your fixed 1-year rate. So getting the best deal from your bank is essentially the first option, and you could be eligible for cashback. If you've been at that bank for 3 years or nearing 4 years or just getting there or thereabouts in that time frame, the bank will give you a cashback. What's the catch? The catch is you must stick with them for the next 3 to 4 years. If you choose to leave in 2 years' time, you will have to pay a portion of that cash back to the bank. The second topic is, when is switching banks worth it? Look, if you've bought a property 3 years ago, right, and you've been at that bank, and let's say your LVR is 80% or less, and you have not got the best sort of cashback offer, or perhaps the rate or your service level that you got from the banker wasn't quite there, or you might have instructions from thinking about how to pay down your mortgage faster by learning new things about mortgage structures. Essentially, those are the factors to consider. If you've got a cashback 1 year in after being at the bank and you're trying to switch banks, you're going to be wasting your time because you'll have to pay them the cashback. So when is switching banks worth it? Essentially, it's not ideal to switch banks unless there is a net benefit there for you. So let's say you're in a position that you've been with a bank for a few years. We're talking 3, 4, 5, haven't gotten cash back since you signed up. You went to the bank, they asked for cash back and you didn't get any. And now you're considering moving banks because you might be able to get 4, 5, 10 grand depending on the level of lending. Essentially, that's a time you may consider it, but that shouldn't be the only reason. When you are moving your debt from one bank to the other, take full advantage of it to learn things like revolving credit, offset mortgages, paying the same repayment even if your mortgage rate has dropped now because you will hit more of the principal. These sort of things should be factored in switching banks because you really want to make sure it's worth it. Sometimes the cashback that you'll get would be real high, and it's because your lending is really high. Normally banks will give between 0.85, 0.9 to 1%, depending on the level of mortgage that you've got or you're taking on with the bank that you're refinancing. And that can pay your rates, insurance, a bunch of other things that come with owning a house, or perhaps any bill that you may have on the house. So that's when you really want to think about switching banks. If you've been with a bank for a year and you've got cashback and you just signed up and now you've seen an attractive deal, you're going to be making a mistake, because you're going to be paying the lawyer, you're going to be repaying that cashback. The one that you're going to get from the other bank may not quite be there. And honestly, it's a silly decision. So that's when it makes sense to switch banks, when you have a way more attractive deal from the other bank and you're planning all these restructures to shave maybe 5, 6, 10 years off the mortgage with a plan. Pop quiz question. Here's a fun question for you. When you are getting a mortgage from another bank, what is the most important cost to be considering when it comes to switching banks? Stay tuned to find out. Okay, so when it comes to switching banks, you want to work out the cost of refinancing. So let's say that you have a $600,000 mortgage at Co-op and you didn't get any retention cashback. You're getting a mortgage rate of 4.99. Now you look at the other side and you've got TSB and same mortgage there, 600,000, and you're getting a rate of 4.89 for the same sort of thing. No sort of difference in terms of the rates. Essentially, you are looking at a difference of 734. Look, it's not much, but it might mean a lot for other people. And then you consider the added benefits. So you know that there's going to be a cost, which is the lawyer. There might be a break cost. Now, what is a break cost? If you are breaking your fixed term, as in you have got a rate at 5.99 and now you're wanting 4.99, and you've got 12 months out, 1% of that $600,000 is essentially going to be the break fee, which is $6,000. So if there's no break costs and there's no cashback to be repaid, then you will get, assuming 0.9% cashback from the bank, $5,400. That means you will be better off by $4,200 in net savings. So if you are better off by $4,200 in net savings, that is how much it would benefit you. And then the difference between the 2 weekly repayments, you add on 416 as annual savings, and then 4,200 would be the net cashback. Okay, now we're going to look at the costs of refinancing. The costs of refinancing are only based on 2 very important bits. Number 1 is the lawyer. Now, when it comes to refinancing your mortgage, we're going to be taking it from one bank and paying them back in full to another bank and starting the mortgage there. Now, this requires a lawyer to manage the money. Mortgage advisors don't touch the money or your loans or anything like that. We are simply facilitating the transaction. The lawyer, for example, if you have a mortgage for $600,000 at Co-op and now you want to go to TSB, you will essentially be getting the money from TSB of $600,000 to pay back Co-op to be able to start a new mortgage at TSB. That is facilitated by the lawyer, and that's $1,200 roughly for one property. If you've got multiple properties, that cost is higher. Then there's the break cost. Now, what is the break cost? Simply put, if you've got a $600K mortgage, and let's say you've got the rate of 5.99, and in about 12 months time, it's coming up for renewal, but today you see the rate of 4.99. The difference between the two is about 1%. 1% of the loan amount being $600K would mean that you would have break costs of $6,000 on a $600K mortgage. So you don't just go willy-nilly, because the break cost is given to the lawyer at the day of settlement. So you would have submitted all your paperwork, and if your mortgage advisor hasn't checked it, or let's say you didn't even have a mortgage advisor, you just went direct, and you get pinged with this bill, it's going to leave a very bad taste in your mouth with your current bank that you're with, that one that you're leaving. And essentially, you could have done your due diligence and understood that there's a break fee involved because you signed up for the contract to pay 5.99 until next year. And now you've seen 4.99. That's great. The cash flow benefit is going to be massive, but the bank will lose out on their margin and they will pass it on to you. So it's very important to consider the lawyer and the break fees on the mortgage that is being refinanced, because the break fee bill comes right at the end. So you really want to avoid that. While we're talking about avoiding refinancing mistakes, break fees should be taken on early if you are breaking a fixed term. We just discussed that. The second thing is, if you've got an existing mortgage, let's say in this example of $600,000, and you are currently paying it in a time frame of, let's say, 22 years, and now you're refinancing the same mortgage across to TSB for 0.1% lower rate, and they sign you up for a $734 repayment on a 30-year term, you're making a silly mistake. You want to make sure you match the term of your mortgage, if not lower. So if you were initially on a 6.99% rate, you're paying $1,028, and now you get on the 4.89 and you think, I need that sort of money in my pocket. If you are really suffering, then that's massively beneficial for you, but we don't advise that. If you can keep the same repayments on the mortgage, so if you're paying $1,028 on the fact that you're on 6.99 and now you're renewing to 4.89, then essentially the weekly repayment should match your existing repayment that you're on 6.99, because you will hit way more off the principal. What I mean by that is this 22-year term, if we drive this down to about 16, maybe that's a bit too much, let's say 17, you've waived 5 years off the mortgage by keeping your mortgage repayment the same. So this mistake is witnessed all the time with many clients. They'll just reset the term to 30, or maybe they didn't get proper advice. So definitely avoid that. Now, really important is understanding that break fees along with resetting the mortgage term are not the biggest mistake when it comes to refinancing. The most massive refinancing mistake that we see everyone make is not setting up the proper structure. If you've got savings, if you've got anything that can offset the mortgage, whether you're a high income earner or whether you want to understand revolving credits or offsets, or perhaps pay the mortgage down faster, you should definitely instill that in the structure. So when clients come to us and we have these meetings with them where we go through graphs and all this sort of stuff with tables and spreadsheets, we design a mortgage structure that fits their income and lifestyle. Now, if you're not overly cautious about that and you don't revisit this annually or every couple of years, you're not going to pay your mortgage off faster at all. Essentially, you're going to be stuck in the trap of paying it down at the mediocre rate that the bank signed you up for. And it'll be a pity, because if you make good money or if you're working hard, you really want to wipe the debt off, because it is a luxury to not have a mortgage and be able to enjoy your income earlier in your life rather than later. With that being said, I hope you enjoyed the video. Please subscribe to our newsletter. We tend to give a lot of value in this at the end of each month, where we go through different things that we're seeing in the market. You can follow us on YouTube, Instagram, or message us directly. You can call us anytime. We've got an amazing team of advisors to help you out. Whether you're looking to just refix the mortgage, understand how to pay the mortgage off faster at your own pace and at your own term, we can definitely help with doing all of that. We've got tons of experience under us. Look, we may look young, but we've got 8 years or 10 years worth of experience for each advisor that's a senior here. And we've gone and done tons of mortgages for Kiwis throughout New Zealand. And we tend to focus on the person and their instructions more with our advice and recommendations. You are ultimately in the driving seat. We just tell you what we think is best, and then you instruct us on what you'd like us to do. So with that being said, thank you so much for watching, and I hope you have a great day.